Imagine walking through a sprawling car dealership at dusk. Rows of brand new cars and trucks stretch as far as the eye can see, paint gleaming under the fading light, but there's an eerie stillness in the air. No customers haggling, no engines starting, just silence and dozens upon dozens of unsold cars sitting idle. This isn't a scene from a dystopian movie. It's happening right now across America, and it's a silent crisis that almost no one is talking about. This might sound surprising or even controversial. After all, we've heard that the economy has been strong, unemployment is low, and consumers are spending. How could car dealerships, of all things, be in crisis? Here's the uncomfortable truth. Behind the optimistic headlines, thousands of brand new vehicles are collecting dust on dealer lots. Dealerships are under immense financial pressure, and the ripple effects of this situation could shake the entire economy if we're not careful. I know what you might be thinking. Cars are always on lots. That's normal. Why is this a crisis? It's true, dealerships typically carry inventory, but what we're seeing now is unprecedented in modern times. Massive unsold inventory piling up to levels we haven't seen in years, maybe decades. Even 2022 model year cars built well over a year ago twice are still languishing on lots, unsold and unwanted. In late 2024, one industry report found nearly 50,000 new 2023 vehicles still on dealer lots across the United States, plus thousands of leftover 2022 models. Think about that. No, cars that are 2 model years old, brand new, never driven off the lot. They should have been someone's shiny new ride last year, but instead they're sitting there depreciating. How did this happen? The answer is a perfect storm. Sky-high vehicle prices, interest rate shocks, and a collapse in affordability have hit at the same time. If you bought a car in the last year or two, you felt it. Sticker prices were through the roof and loan rates doubled from what they were just a couple of years prior. Many consumers simply said no thanks and walked away. As demand cooled, dealers and automakers were left holding the bag. Lots full of expensive cars that fewer people can afford. I want to take you through this unfolding crisis step by step, from the dealership floor where unsold cars are stacking up to the wider economy where the shock waves might spread. We'll talk about unsold inventory, floor plan financing pressure, oversupply of electric vehicles, interest rate whiplash, and crumbling consumer demand. We'll dive into the psychology of what happens when an industry hits a wall, how fear and panic can spread if we're not careful. We'll draw parallels to historical episodes, times when things looked eerily similar, and see what lessons they hold. And finally, I'll share some pragmatic thoughts on how we can navigate this storm. Whether you're an investor trying to protect your portfolio or an everyday person worried about your job, your debt, or just putting food on the table. This isn't about being a pessimist. It's about facing reality head on. I've been fortunate in my life to see many sides of how the world works. The tech booms and busts, the financial crises, the bubbles and the bursts. I've seen what happens when we ignore warning signs, and I've seen the power of acting early to prevent disaster. Right now, what's happening in the car market is one of those warning signs, a big one, and I feel it's my responsibility to speak up about it. So buckle up. Let's explore why those quiet, empty car dealership lots at dusk are a warning we shouldn't ignore, and what it means for all of us in the coming months and years. The crisis might be silent for now, but as you'll see, the consequences could be deafening. Let's start at ground zero of this crisis, the dealership. Picture the typical American car dealership business model. Dealers don't usually pay cash for all those cars on their lot. They finance their inventory. It's called floor plan financing. Essentially, the dealer takes out a loan to buy cars from the manufacturer and then sells those cars to customers. The longer a car sits unsold, the more interest the dealer pays on that loan, eating into any profit they'd make when the car finally sells. In normal times, this system works smoothly under cars sell quickly enough that financing costs are manageable. But these are not normal times. Over the past year or two, interest rates have skyrocketed at a pace we haven't seen in decades. The Federal Reserve, in a bid to fight inflation, raised benchmark rates from near zero to over 5%. That's like going from a calm cruise to hitting a brick wall at full speed, a financial whiplash for anyone relying on cheap credit. For car dealers, it has been devastating. The cost of floor plan financing exploded almost overnight. Just a couple of years ago, interest rates were so low that keeping inventory was relatively cheap. Some dealers even enjoyed income from floor plan allowances. Manufacturers often subsidized interest when inventory was tight. But now, with rates high, those days are over. Instead of getting help to stock cars, dealers are bleeding cash to carry unsold vehicles. Consider this astonishing fact. Through the first 3 quarters of 2024, the average U.S. car dealership paid over $100,000 in interest just to finance its inventory. Compare that to the same period a year earlier. Instead of paying interest, dealerships were actually making about $20,000 in positive revenue from manufacturer incentives that offset financing costs. In 1 year, the situation flipped from a $20,000 gain to a $100,000 plus expense. That's a $120,000 plus swing in costs for the average dealer. And remember, that's average. Many dealers with larger inventories or more expensive vehicles like big trucks and luxury cars faced even higher interest expenses. This is pure added cost, money that produces nothing, contributes nothing to growth. It just drains away profits day by day, car by car. Now, layer on top of that the fact that inventory levels have jumped significantly from the lean pandemic years. After 2020 and 2021, when a global chip shortage meant dealers had barely any cars to sell and could charge premiums on those they did have, automakers ramped production back up. By late 2022 and into 2023, cars started flowing back onto lots. At first, dealers were thrilled to have merchandise again, but then reality hit. Consumers were no longer eager to buy at any price. By 2024, many dealerships found themselves swimming in vehicles. Nationally, new car inventory rose sharply from the lows of the pandemic. It's still not fully back to the bloated lots of 2019, but it's close, within about 20% of pre-pandemic levels overall. The problem is demand hasn't returned to 2019 levels, not even close, so we have almost as many cars as before, but far fewer willing buyers. Let's talk specifics. Some of the hardest hit brands and models paint a vivid picture of this glut. Take Jeep's Grand Wagoneer, a high-end luxury SUV that costs over $100,000. By the end of 2024, 1 out of every 5 Grand Wagoneers sitting on dealer lots was actually a 2023 model, nearly 2 years old, never sold. Dealers had hundreds of them nationwide just parked, gathering dust, because there simply aren't enough wealthy buyers for giant $100,000 SUVs right now. Jeep's parent company started slashing prices and offering incentives to move the metal, but even at discounts, those units aren't exactly flying off the lot. It's not just super luxury trucks, though. Even mainstream brands are affected. Nissan, known for more affordable cars, saw its U.S. dealerships' profitability plunge to a 15-year low in 2024. Why? They had too many cars and not enough takers, losing market share and struggling to move inventory. When a brand known for economy cars can't sell in an economy where many people are looking for value, you know something's fundamentally broken. It tells us this isn't just a luxury problem or a niche problem, it's widespread. Perhaps the most striking case is what's happening with electric vehicles, EVs, on dealer lots. Just a couple of years ago, EVs would sell out months in advance. Many buyers were on waiting lists, excited to go electric. Automakers saw that enthusiasm and rushed to roll out new EV models, investing billions in factories and battery plants. Fast forward to today, and the narrative has flipped. We're now hearing words I honestly didn't expect so soon. EV oversupply. Dealers are reporting that electric cars have become their slowest moving inventory. I recently spoke with a dealer in the Washington, D.C. area who carries several brands, including Ford, Volkswagen, and Hyundai, all of which offer EV models. He told me bluntly, the EVs are just not moving. We built them, and the customers didn't come. On his lots, he has over a 100-day supply of EVs at current sales rates. For context, a 60-day supply of cars has historically been considered balanced. 100-plus days is excess by a wide margin. What does an oversupply of EVs look like in practice? It means price cuts and lots of them. EV prices, which were once firm and rising due to high demand and costly batteries, are now dropping as dealers beg for buyers. In fact, industry data shows EV discounts hit all-time highs in late 2023. Automakers like Ford slashed prices on their F-150 Lightning electric pickup by thousands of dollars. Tesla, the EV leader, aggressively cut prices on its models throughout 2023 to stoke demand, a move that grabbed headlines. General Motors, facing weak demand, actually delayed production of certain new electric trucks, basically hitting the pause button because they see the cars already on lots aren't selling fast enough. It's ironic. We need EVs to fight climate change in the long run, but in the short run, automakers may have overestimated how many people can afford them or want them right now. Early adopters bought in, but the next wave of consumers is more cautious, concerned about high prices, charger availability, or simply strapped by the cost of living. So dealers have brand new electric SUVs and cars just sitting, and unlike gasoline cars, which some old school buyers might still pick up out of habit, EVs appeal mainly to those specifically seeking them, a more limited pool. The result, EVs are stacking up, adding to that inventory glut and further straining dealers' finances. Now, put yourself in the shoes of a dealership owner for a moment. You've got a lot designed to hold, say, 200 cars, and you're currently sitting on 250. Your showroom is overflowing, your backlot is full, maybe you're even renting extra storage. Each of those vehicles isn't just gently waiting for a buyer, it's costing you money every single day. The bank or finance company that funded your inventory expects their interest payments monthly. On a typical new car that might wholesale for $30,000, at current interest rates, you could be paying around 7 to 8% annually to finance it. That's roughly $2,000 per year in interest, or about $5 to $6 per day for each car. Multiply that by 250 cars and you're looking at $1,250 per day in interest costs. Extend to a month, that's around $37,000. For a quarter, over $100,000 lisjan, which matches that national average figure we mentioned. It's like a meter is ticking next to every car. Cha-ching, cha-ching, draining your cash. If some of those cars are higher-end trucks, SUVs, EVs that cost $50,000 to $60,000, the interest per car is even higher. You could easily be burning $2,000 or $3,000 a day on interest across your stock. Just interest. That's before we talk about rent, payroll for your sales and service staff, utility bills, insurance, and all the other overhead of running a dealership. So what do? The obvious answer is sell those cars fast, even if it means cutting the price. And indeed, many dealers are now heavily negotiating and discounting on models that were going for sticker price or higher last year. We're seeing the return of incentives, big rebates, and clearance sales for leftover inventory. A recent year-end analysis suggested buyers aim for at least 15 to 20% off MSRP on those leftover 2023 models, because once the calendar flips, that car is officially last year's model and takes a big depreciation hit. Dealers know this and they're wheeling and dealing like it's 2019 again, trying to convert inventory to cash. But slashing prices has its own problems. For one, it hurts profit margins. You might clear the loan, but make no profit or even a loss on each car. It also upsets customers who paid full price earlier, and it upsets automakers who don't want their brands devalued. Automakers set quarterly targets and don't like when dealers dump cars cheap, as it undercuts the value of new models. There's tension. Dealers need to survive today. Automakers want to keep pricing power for tomorrow. This standoff can't last forever. If inventory doesn't clear, automakers will have to eventually cut factory output. They can't keep shipping new cars to dealers who can't sell the ones they have, and that is exactly what we're beginning to see as with the EV production slowdowns. It's a vicious cycle brewing. High interest costs force dealers to discount to move cars. Discounts erode brand value and future demand. Why buy today if you think prices will be lower tomorrow? Automakers then face lower sales and might need to offer incentives or cut production, which hits their bottom line and potentially leads to layoffs at factories. Dealers, meanwhile, even if they sell cars, aren't making the profits they need to stay healthy. The golden days of 2021, when people paid $5,000 over sticker for a car because supply was scarce, are long gone. An auto industry insider might say we're returning to normal, but this doesn't feel like a stable normal. It feels like an unstable imbalance, one that's tilting towards a breakdown. And there's one more twist. Consumer behavior has shifted in ways that dealers and automakers were not fully prepared for. During the pandemic and the stimulus era, many Americans had extra cash or could get ultra-cheap loans, so they upgraded their cars. There was a burst of buying in late 2020 through 2022. Even though supply was constrained, the demand was intense. Now, a lot of those people have newer cars and trucks. They're not in the market anymore. The folks who are left in the market are often there because they need a car, their old one is dying, or their lease is up, not because they want a new car. It's a much more price-sensitive group. So the dealerships are effectively fighting over a smaller pool of willing buyers, many of whom are extremely price-conscious or struggle. So the dealerships are effectively fighting over a smaller pool of willing buyers, many of whom are extremely price-conscious or struggling with their own finances. That's a tough sell, literally. So here we are. Dealers strained by financing costs, burdened with bulging inventories of both conventional cars and EVs, and seeing thinning profit margins as they cut deals to keep the lights on. It is a profoundly uncomfortable place for the industry to be, especially coming off the high of the recent boom. Some dealerships will weather this by tightening belts, moving cars in volume at little profit, and relying on their service and parts departments to stay afloat. Indeed, many dealers are now leaning on repair services to make money since selling cars isn't as lucrative. But some dealerships won't make it. The smaller ones, the ones that over-leveraged when times were good, or those tied to brands that are struggling, they could go under if conditions don't improve. We may see dealership closures or consolidations, especially in areas with lots of competition or weak demand. It's happened before in downturns. 2008's crisis wiped out thousands of dealerships across the country, and we could be on the verge of another culling of the herd. Before I move on, let me underscore this point. This isn't just speculation. The numbers are there for anyone to see. Inventory up, sales down, interest up, profits down. I often say measure what matters, and by every measurement that matters to a car dealer, things are headed in the wrong direction. If this trend continues, the dealership crisis could deepen into an automotive industry crisis. And if that happens, it won't confine itself to showrooms and car lots. It will spill over into the broader economy in painful ways. Let's talk about why. If American car dealerships are on the ropes, what does that mean for American families, for jobs, for the financial system? To answer that, we need to step back and look at the bigger picture of affordability and consumer debt that underlies this whole situation. Why exactly are cars piling up unsold? It boils down to a simple and harsh reality. Millions of Americans can no longer afford to buy the cars that manufacturers are building. In the span of just a few years, the cost of buying a vehicle, whether new or used, has shot through the roof, while most people's incomes have not. We're witnessing a collapse in car affordability, and it's a key driver of this crisis. Let's throw out some eye-opening figures. The average price of a new car in the U.S. has hovered around $45,000 to $50,000 in recent times, an all-time high. But price is only half the story. The other half is how you pay for it. The vast majority of car buyers rely on loans or leases to drive off the lot, and those loans have suddenly become far more expensive. At the start of 2022, you could find auto loans with interest rates of maybe 3 to 4% if you had decent credit. By late 2023, the average interest rate on new car loans was around 7 to 8%, with used car loans often above 10% for many buyers. That means the same car at the same price now costs hundreds more per month in payments compared to a few years ago. To illustrate, in 2019, the typical monthly payment on a new car was about $500 to $550. Today, the average new car payment is roughly $700 to $750. Think about that jump. That's an extra $200 or more every month, which is huge for a family budget. In fact, a recent report showed it's a 30% plus increase in just 4 years. Wages certainly haven't grown 30% for the average household in that time, and it gets worse. About 1 in 5 new car shoppers in 2025 have been committing to monthly payments of $1,000 or more. 1 in 5, a $1,000 car payment used to be a rarity, seen only with luxury vehicles or for buyers with awful credit. Now it's almost mainstream, which is terrifying. To afford that kind of payment by traditional measures, a household should be making well into 6 figures of income. Yet many are stretching to make it work because car prices and rates left them no choice if they needed a vehicle. What do people do when they can't afford the monthly payment? Some just walk away. They don't buy, which contributes to the lower demand. Others try to make it work by spreading the loan over a longer period. We've seen a surge in 84-month car loans. That's 7 years of payments. Over 22% of borrowers in 2025 took out loans of 6 or 7 years. Imagine still paying off your car in 2030 for a vehicle you bought in 2023, and likely by then the car is worth far less than what you owe. It's like mortgages, but for a depreciating asset that will likely need costly repairs by the time it's paid off. This is how people are coping, by taking on more debt for longer just to afford the same car. Many others are opting out of the new car market entirely and either keeping their existing cars longer or buying used. But guess what? Used car prices also shot up during the pandemic due to that shortage of new cars at the time. They have come down from the absolute peak, but they're still much higher than pre-pandemic. A used car that cost $15,000 a few years ago might be $20,000 now. And if you finance a used car, rates are even higher because banks charge more for used car loans. The collateral is older, more risk. So used car buyers face an average payment over $500 now, which again is way above what it used to be. In short, we have a situation where car prices went up approximately 30 to 50% in a few years, and interest rates roughly doubled or more, while incomes maybe rose 10 to 15%, if that, over the same span. That math simply doesn't work for consumers. Something had to give, and what gave was consumer demand. People are either unwilling or unable to pay these prices, so they're buying fewer cars. It's economics 101. If prices overshoot what the market can bear, sales drop. We're now seeing those dropping sales in certain segments, especially for those pricey models and EVs as mentioned. Even overall, new vehicle sales, which did rebound in 2023 from the supply-constrained 2020 to 2022 period, are not looking like they'll zoom back to the record highs of the 2010s given these affordability issues. And going into 2025, many analysts expect sales to soften again as the full effect of higher rates weighs on consumers. Let's not forget, there's a broader context. Household finances are under strain in general. It's not just car loans, it's everything. Over the last 2 years, Americans have faced sharply higher costs for food, housing, energy, you name it. Inflation, while easing a bit now, made the basics much more expensive. Meanwhile, pandemic-era savings have dwindled for a lot of families, and many who enjoyed a break on student loan payments or rent moratoriums have seen those bills resume. To cope, people have leaned on credit cards, pushing credit card debt over the $1 trillion mark, an all-time high. And guess what? Credit card interest rates are above 20% on average. Brutal. So you have households juggling more expensive rent or mortgages because, yes, mortgage rates hit 7 to 8% too. Higher grocery bills, hefty credit card payments, and now you expect them to take on a $700 car payment? Many simply can't. Something has to drop from the budget, and a new car is often a discretionary or delayable purchase. People figure, I can nurse my old car along a bit longer, or maybe we can manage with one car instead of two for now. This is rational behavior, but when millions make that choice, it creates a huge demand vacuum in the auto market. Another factor, consumer debt and defaults are creeping up, particularly in auto loans. It tends to start at the margins. The most vulnerable borrowers feel it first. Right now, we're seeing record high delinquency rates among subprime auto loan borrowers. Subprime means folks with lower credit scores, often lower income, who already pay higher interest on their car loans. As of late 2025, about 6.6% of subprime auto loans are over 60 days delinquent, the highest level ever recorded, even higher than during the 2008 to 2009 recession. Think about that. More than 1 in 20 subprime borrowers are essentially defaulting on their car loans right now. That is a clear sign that many Americans on the lower end of the economic spectrum are completely stretched beyond their limit. High interest, high inflation, and maybe job instability have hit them hard, and their struggles are a canary in the coal mine for the rest of us. Because typically when defaults rise among subprime borrowers, lenders tighten up credit for everyone. They get skittish. We're already seeing some subprime-focused auto lenders go bankrupt because of these losses. And mainstream banks are also becoming more cautious with auto lending, especially on longer-term loans or for people with borderline credit. This means even some people who want to buy a car and think they can afford the payment might not get approved for a loan. Now, tightening credit conditions are like the oxygen being sucked out of the room for auto sales. So we have a feedback loop. Cars too expensive. Fewer people buy, Enacio. Those who do buy often stretch too far. Defaults rise, banks pull back. Even fewer people can buy. It's a dangerous cycle for an industry that relies on an endless chain of consumers taking loans to purchase a depreciating product. Let's focus on one special part of the affordability story, electric vehicles, EVs, again, but this time from the consumer's angle. EVs were already typically more expensive up front than their gasoline counterparts, even though they promise lower fuel and maintenance costs over time. Governments have offered rebates and tax credits to help, but even with those, many EVs are in the $40,000 plus range. Now add higher interest rates, and the fact that many EV tax credits require you to wait until tax season to benefit or involve jumping through hoops with dealers. For a lot of middle-class buyers, an EV became even more out of reach in the past year. Plus, the used EV market is only just developing, and some people worry about battery longevity and resale value, so they're hesitant. The result, EV adoption is stalling a bit after a period of rapid growth. It's not that people don't want EVs. Surveys show plenty of interest, but the economics have given many would-be buyers cold feet. And unlike gas cars, where you can always opt for a cheaper used model or a basic trim, with EVs, the choices in the truly low-budget category are almost non-existent. This is one reason those EVs are stacking up unsold. They were targeted at a market segment, upper middle class early adopters, that isn't growing as fast now, especially under financial constraints. I also want to highlight the psychological side of affordability. Buying a car is as much an emotional decision as a financial one. When people feel confident, their job is secure, the economy looks good, and money is cheap, they'll splurge on that new truck or SUV. But when they feel uncertain, worried about a recession or their bills piling up, or they hear that interest rates are high, they become cautious. They delay big purchases. The consumer psyche in America has shifted over the past year from a free spending mood. Remember all those stories of people taking lavish vacations or bidding wars on houses in 2021, to a more defensive, hold tight to what you have mood. Consumer confidence surveys in late 2024 showed sentiment taking a dip as people expressed concerns about the future. When confidence falls, big-ticket items like cars are the first to get cut from the shopping list. So here's the big picture of this section. The average American's ability and willingness to buy a car has been severely undermined. High prices plus high interest equals high monthly payments. Beyond what many can manage, people responded logically by buying fewer cars or not buying at all. That, in turn, left dealerships with more inventory and forced this crisis at the lots that we described earlier. This is not a temporary blip that will fix itself next month. It's a structural issue. Unless car prices come down significantly or interest rates drop or incomes jump, and none of those look likely in the immediate term, we can expect car sales to remain under pressure. And if car sales remain weak while production was geared for a higher level, the imbalance persists, keeping dealers in a tough spot. Now you might say, well, eventually won't prices come down if cars aren't selling? Yes, that's the market at work, and it is starting to happen through discounts and incentives. But there's a lag and a lot of pain in that process, and it can overshoot into a crisis of its own, where prices collapse so fast that it hurts everyone: owners, dealers, automakers, lenders. We saw this with housing in 2008. Homes became unaffordable, sales slowed, then prices crashed, and that crash caused massive collateral damage. The auto industry is smaller than housing, but it can still cause plenty of damage if a similar dynamic plays out. We need to consider those parallels and the potential ripple effects, because the collapse in affordability doesn't just hurt potential car buyers, it signals deeper problems that can reverberate throughout the economy. In the next section, let's explore those ripple effects, the psychology of what might come next, and how history shows us similar moments and their aftermath. We've seen what's happening on the car lot and in family budgets. Now let's zoom out to the whole economy. Are these just isolated troubles or the first dominoes in a larger chain reaction? As I'll explain, cracks in the auto market often foretell cracks in the wider economy, and the psychology of panic can turn a contained issue into a systemic crisis if we're not vigilant. Financial and economic crises have a strange way of sneaking up on you. Everything can look fine on the surface: growing GDP, low unemployment, stock markets humming, and then, almost out of nowhere, a seemingly contained problem spreads like wildfire. Suddenly, confidence evaporates and everyone starts pulling back, making the crisis far worse. I'm not saying we are doomed to have that outcome here, but the scenario I've described in the auto industry has the potential ingredients for a broader contagion, especially if fear takes hold. Let's play out a hypothetical but plausible scenario of how panic could spread from car dealerships to the rest of the economy. It starts with the dealerships themselves. Imagine in the next few months a couple of sizable auto dealer groups, especially ones carrying a lot of inventory and dealing in lower-priced cars, announce that they're in financial trouble. Perhaps one even files for bankruptcy, unable to service its floor plan loans because sales collapsed and interest costs ate all their cash. This would be a big wake-up call. Car dealer bankrupt due to unsold inventory glut. Not a headline Americans are used to seeing since the early 1990s or 2008. Consumers reading that might think, wow, if dealers are going bust, maybe I should really hold off on buying a car. I bet prices will drop more, or I could get a great deal from liquidation sales. So even people who are on the fence about buying now decide to wait. Demand falls further. More inventory piles up. Meanwhile, automakers notice their dealers are canceling orders or refusing new shipments. They scale back production schedules. That means less work for factories. Auto manufacturing employs a lot of people, not just at the big assembly plants, but in the supply chain. Parts, factories, tire makers, glass, steel, computer chips, you name it. If production cuts deepen, temporary layoffs might hit auto workers. Perhaps overtime is cut first, so workers earn less. Then shifts eliminated, then maybe entire plants go idle for weeks. Those workers, now with smaller paychecks or none at all if laid off, naturally cut back their spending on other things, dining out, shopping, vacations, which then hurts local businesses and their communities. The effect can radiate outward from the industrial heartland to all over the country. At the same time, the banks and lenders who finance both the dealers and the car buyers start getting very nervous. They've already seen delinquencies rising. A dealer bankruptcy means the bank might have to repossess a lot full of cars and auction them off for less than the loan value. Not a good situation for lenders. They tighten credit standards even more. Maybe they stop lending to smaller used car dealers or cut off subprime lending programs. Suddenly, many consumers find they can't get car loans at all, or they're offered such a high rate that it's effectively a denial. This credit crunch further chokes off demand for autos. It also could spread to other credit. An auto loan is often one of the first debts people default on, since unlike a house, you can sometimes get by without a car or share one. If banks see heavy losses in their auto portfolios, they might get skittish about credit cards or other personal loans too, tightening those. In 2008, we saw how losses in one asset class, housing, made banks pull back everywhere, fueling a credit crisis. Autos aren't as large a market as housing, but the psychological effect on lenders can still be significant. Bad news in any consumer debt sector makes them generally more risk-averse. Now consider consumer psychology. We humans are funny creatures. We swing from euphoria to panic sometimes faster than economic fundamentals warrant. If news spreads that car sales are collapsing or auto industry in turmoil, it can feed a narrative that the economy is in trouble. People might recall 2008 when Detroit automakers almost went under and think, oh, is this happening again? Are we going into a recession? With talk of recession in the media, which there has been off and on recently, such news can be a tipping point for sentiment. When consumers fear a recession, they pull back spending across the board to save money just in case. That reduced spending then causes the very downturn they feared, a self-fulfilling prophecy. Big purchases get axed first, cars, appliances, new homes, then even smaller discretionary buys. Businesses then see sales slow and themselves get nervous, perhaps pausing hiring or investment. You can see how quickly fear can cascade into real economic contraction. The auto industry has a unique place in the American psyche and economy. It's not just another sector. It's often seen as a bellwether. People gauge the economy by whether people are buying cars. When Detroit sneezes, we worry the country might catch a cold. And historically, guess what? Auto sales have tended to peak and start falling before recessions. It's a durable goods sector that reacts to interest rates and consumer confidence early. We might already be seeing that. Auto sales rebounded in 2023 from the supply-constrained slump, but many believe 2023 might have been the peak of this cycle. If 2024 to 2025 see declines in car sales, that's a strong recession indicator. Now, correlation isn't causation, but the pattern is there, and people and policymakers know it. It can influence decisions. For example, the Federal Reserve will be watching auto sales and credit data. If they see it tanking, they might worry they tightened rates too much. There's also a historical parallel that could spook folks. Think back to 2008. What were some early signs of trouble before the big crash? Housing is the obvious one. Home sales and prices started falling in 2006 to 2007. But not far behind was auto sales. In 2008, as the financial crisis hit, car sales absolutely plummeted. In 2009, new vehicle sales in the U.S. fell below 11 million units, down from over 16 million a few years prior. It was like a 35% drop, an unprecedented collapse in modern times. General Motors and Chrysler had to declare bankruptcy, with government bailouts to restructure sets, and Ford barely avoided it by mortgaging everything beforehand. Over 2,000 dealerships closed their doors because there just wasn't enough business to sustain them. It was carnage, and it contributed to the overall recession deeply. Hundreds of thousands of auto workers lost jobs. Communities were devastated, and even the federal government stepped in with programs like Cash for Clunkers to stimulate car buying again. Now, the current situation is not identical to 2008. That was triggered by a banking meltdown and housing crash. But the auto sector's vulnerability was a big part of why that recession cut so deep. If autos tank again, even without a housing crash, it can still cause serious economic pain. It's one of the biggest manufacturing industries we have, and autos are tied into so many other sectors: advertising, tech, raw materials, dealerships, which are big local employers, etc. Let's go further back. The late 1970s and early 1980s, another period of high inflation and rising interest rates. The Federal Reserve under Paul Volcker jacked up rates to kill inflation, which they did, but not without a very painful recession in 1980 to 82. And guess what? The auto industry was front and center in that pain. Car sales in those years fell dramatically as interest rates for car loans soared into double digits. Imagine a 15% car loan. That was reality then. Consumers facing high gas prices on top of high rates simply stopped buying Detroit's gas guzzlers. By 1982, Ford's U.S. car sales were almost 50% lower than just 4 years earlier. Thousands of auto workers were laid off, and Chrysler had to be bailed out by the government in 1979 to avoid collapse. It was a crisis born from a mix of economic conditions and industry missteps. Sound familiar? The lesson from that era: when interest rates spike, interest-sensitive industries like autos can go into free fall, and it takes years and major interventions to recover. Even further back, during the Great Depression of the 1930s, auto sales were crushed. From 1929 to 1932, new car sales fell by almost 75%. Think about what that means. 3 out of 4 people who might have bought a car didn't. Factories shut down. Companies went under. Some car makers like Studebaker and others never recovered from that downturn. It showed how a severe economic shock can practically freeze an entire industry. Now, thankfully, we are nowhere near Great Depression conditions today. That was a unique cataclysm, but I mention it to highlight that autos are not immune to massive contractions. If anything, they are prone to them when times get tough. There's also the psychological parallel to housing that I want to draw. Remember the housing bubble? People kept buying homes because they thought prices would only go up and they better get in or be left out. That speculative fever drove prices beyond what people could truly afford with the help of loose lending. Eventually, reality caught up, prices started to fall, and when they did, buyers disappeared because why catch a falling knife? That in turn made prices fall faster, leading to panic and a crash. Now apply that psychology to cars, albeit on a smaller scale. We had a sort of mini bubble in car prices, fueled by shortages and cheap money. Prices went way above MSRP, used cars even appreciated, an absurd situation historically. Now prices are softening. If consumers collectively think cars will be cheaper next month or next quarter, I'll wait, then demand today drops. That forces dealers to cut prices more aggressively to make any sale, reinforcing the consumer expectation that prices will drop further tomorrow. It becomes a deflationary spiral for car prices, good for the eventual buyer who waits long enough, but terrible for those caught with high loans. They'll owe more than the car is worth, and for the industry trying to operate normally. A rapid price correction in autos could indeed cause some chaos. Lenders would worry about their collateral. If a repoed car fetches far less at auction, the bank eats the loss, and recent buyers might default strategically or stop spending on other stuff because they feel poor. Their car equity is gone, etc. I'm painting a dire picture here, and not every domino is guaranteed to fall. We could see a more controlled adjustment. Maybe the Fed cuts rates in time to cushion the fall, or automakers manage production smartly to avoid absolute glut. Or maybe consumers gradually return as prices stabilize, but the risk of a sharper unraveling is there. And crucially, the fear of that risk can itself trigger defensive actions that make the risk greater. For example, if the Federal Reserve or federal government gets very concerned about the auto situation, they might implement policies like rate cuts or stimulus targeted at consumers to support it. That could help, or it could spook markets by signaling they see something very wrong. Investors might then worry, what do they know that we don't? Is a recession imminent? Sometimes trying to avert panic can unintentionally raise alarm if done clumsily. It's a delicate dance. On the flip side, if policymakers ignore the issue and say, oh, it's just a normalization after a boom, they could be caught flat-footed if things deteriorate quickly. Confidence is a fragile thing, both consumer confidence and investor confidence. A blow-up in a sector like autos can deliver an outsized shock relative to its economic weight because it's so visible and relatable. Everyone either owns a car or knows someone who does. A car is the second biggest purchase most people ever make, after a home. So car trouble feels very real to ordinary people, more so than, say, an aerospace downturn or a semiconductors inventory glut. Thus, it can influence behavior broadly. Let me also address systemic parallels beyond autos, because autos might not be the only domino. They could be the first in a line of several. If higher interest rates and squeezed consumers are causing issues in autos, they might also cause issues elsewhere, like in retail or in credit cards or housing rentals or, God forbid, housing prices again. We already see commercial real estate struggling with high interest and low office occupancy. Sometimes a small crack in one place is a harbinger of bigger cracks forming in other places. The challenge is to tell which is which. Is the auto industry uniquely suffering, or is it just ahead of the curve? I suspect it's a bit of both. Autos have unique issues, the whiplash from shortage to glut, the EV transition costs, etc., but they also reflect general trends. Consumer stress, high interest. We've talked about subprime auto loans hitting record defaults. Well, credit card defaults are also rising, and student loan payments just resumed after a long pause. Likely we'll see more strain there too. If you add all these up, you get an image of the American consumer who powers 70% of the economy beginning to falter. When the American consumer falters, a lot of things can go south quickly, from corporate earnings to employment. Contagion is a scary word, but it's something we have to consider. In 2008, what started as a subprime mortgage problem, a relatively small segment of housing loans, snowballed into a global financial crisis because of contagion, fear, and interlinked finances. In our current context, auto loans are not big enough to blow up the banking system on their own, but they can contribute to a broader credit squeeze. There's also the psychological contagion, bad news in autos adding to a general narrative of the economy is cracking under high rates, which then causes investors to maybe pull back, stock prices fall, hurting 401ks, and causes CEOs to get cautious, hiring freezes or layoffs to brace for recession. It can all feed on itself. I'm stressing the worst case scenarios not to scare, but to highlight that small fires can merge into a big blaze if left unchecked. And right now we have a few small fires burning, the auto dealership crisis being one of them. Before moving on to how we might deal with all this, let's briefly touch on some echoes from history in a more structured way. I think it's important to realize that what we're facing isn't entirely new. There are patterns, and if we recognize them, we might better avoid repeating past mistakes. As Mark Twain reputedly said, history doesn't repeat itself, but it often rhymes. So what rhymes are we hearing now? Let's take a step back and compare today's situation to previous economic warnings and crises. It might surprise you how much our current predicament has in common with past events, and what those past events can teach us about what to do next. Standing here in 2025, describing car lots filled with unsold inventory, interest rates spiking, and consumers under strain, I can't help but feel a sense of déjà vu. We've been here before. Not exactly here, but in places that rhyme with here. Let me take you on a quick journey through a few historical moments because they provide valuable context and cautionary tales for what we're facing now. 1979 to 1982, the last interest rate shock. The late 70s and early 80s were the last time before now that America saw interest rates jump so high so fast. Back then, it was even more extreme. The Fed raised rates above 15% to break the back of runaway inflation. It succeeded in taming prices, but the cost was a severe recession. The auto industry in those years was one of the biggest casualties. In 1979, as I mentioned earlier, a perfect storm hit. An oil crisis sent gasoline prices soaring, and the Volcker rate hikes made car loans prohibitively expensive. Auto sales, which had been strong at the decade's end, went into a tailspin. By 1982, U.S. automakers were selling roughly 45% fewer cars than just a few years prior. Think about that, nearly half the business gone. Ford was losing billions and slashed nearly 100,000 jobs. Chrysler nearly died. It had to beg the federal government for loan guarantees in 1979, about $1.5 billion, which was a lot more in today's dollars, just to stay afloat. The government agreed, but only after Chrysler agreed to deep restructuring and the United Auto Workers Union made big concessions. It was a national news story, a pillar of American industry on its knees. What did we learn? High interest rates can strangle consumer spending on durables fast. Also, industries that fail to adapt. Chrysler was selling big gas guzzlers nobody wanted when gas prices spiked. Can implode. We also learned the value of timely intervention. That bailout saved tens of thousands of jobs, and eventually Chrysler recovered for a while. Anyway, for us now, the takeaway is to not underestimate how quickly things can unravel when monetary policy shifts dramatically. The Fed today is very aware of this history. The question is, how long will they hold rates high? And will they adjust in time if things like auto sales nosedive? It's a tough balance. Cut rates too late, you get a deep recession. Cut too early, inflation might reignite. Back in 1980, they actually cut rates when a recession hit, then had to raise again because inflation was sticky, causing a double-dip recession. We don't want a repeat of that oscillation. So there's a bit of 1980 and 2025's ear whispering, rot, be careful, you've seen what can happen. 2008 to 2009, the Great Recession and auto bailouts. Most of us remember the 2008 crisis all too well. I certainly do. It was a period of immense anxiety even for someone of means because so many lives were upended. Housing was the epicenter, but the auto industry was another ground zero. By 2008, Detroit's big three, GM, Ford, Chrysler, were in dire shape. Years of declining market share, an over-reliance on gas-guzzling SUVs, which again had a problem when gas spiked to $4 a gallon in 2008, and the sudden collapse of credit availability left them without customers or capital. As credit markets froze, car loans became harder to get, and many people couldn't buy cars even if they wanted to. Auto sales free fell, hitting lows not seen in decades. By late 2008, General Motors, the largest automaker in the U.S., was basically insolvent. Chrysler, too. Ford was slightly better off only because it had borrowed heavily before the crisis, a risky move that ironically saved them by giving them cash to burn. The government stepped in with the Troubled Asset Relief Program, TARP, not just for banks, but also to support GM and Chrysler through structured bankruptcies. In 2009, those two companies went bankrupt and were reorganized with federal loans, while Ford restructured itself voluntarily. As part of this, over 2,000 dealerships were terminated. GM and Chrysler cut ties with many local dealerships to streamline. It was extremely painful for communities. Suddenly, the local Chevy or Dodge dealer that had been around for generations was gone, along with its jobs. The lesson here was multifaceted. We saw how quickly a broad economic crisis can bring the auto industry to its knees, even if the industry's own issues had been building for years. Sound familiar? Building issues, then sudden trigger. We also saw how essential government and central bank intervention can be to prevent total collapse. If GM and Chrysler had liquidated entirely, the shock to the economy would have been even worse. Millions of jobs potentially lost at its peak. And we saw that recovery takes time. It wasn't until about 2012 to 2013 that auto sales really bounced back strongly. The government eventually got repaid in part, not fully in all cases, for the bailouts, and the taxpayers essentially decided that saving the industry was worth the cost to avoid bigger fallout. Now today, thankfully, the automakers themselves, especially GM and Ford, are not in a similarly precarious financial state as they were pre-2008. They have had strong profits the last few years thanks to high car prices, and they've cleaned up their balance sheets a lot since the bankruptcy era. So I'm not predicting GM is about to go bankrupt again or anything, but if there were a severe enough downturn, even healthy companies can bleed cash quickly. And the ripple to suppliers and dealers could again require some kind of intervention if it spiraled. One could imagine, for instance, if EV sales don't pick up, maybe some government incentives or programs might be expanded to spur demand, like an EV version of cash for clunkers or bigger tax credits, to help automakers transition without imploding. That's speculation, but not far-fetched if things worsen. Even outside these big famous episodes, there are smaller echoes. In the early 90s, for example, the U.S. had a mild recession, 1990 to 91. Auto sales dipped and many dealers struggled then too. The early 90s also saw a spike in oil prices due to the Gulf War and a credit tightening. It led to weaker car sales and some industry distress, though nothing on the scale of 1980 or 2008. The government at that time didn't bail out car companies, but it did in that era help the economy through rate cuts and some stimulus. The 90 to 91 recession was short, and pent-up demand later in the 90s led to booming car sales later. The lesson: even a normal recession causes auto sales to slump significantly. But if the downturn is mild and brief, the industry can recover without drastic measures. How about Japan in the 90s? Their asset bubble burst in 1989, and the 90s were a lost decade economically. Japanese car companies survived because they aggressively went after export markets like the U.S., but their domestic sales stagnated badly. One interesting thing: Japan ended up with a phenomenon of excess inventory and a sort of deflationary spiral for years. People kept waiting for prices to fall because they saw deflation year after year. That's an example of how powerful the psychology of falling prices can be in any market. If U.S. car buyers believe, hey, if I just wait a bit, I'll get a better deal, then demand today evaporates. It's rational for the individual, but collectively it can stall an economy. Also consider the tech bubble burst in 2000 to 2001. That wasn't directly about cars, it was more stock market and investment driven, but it triggered a mild recession in 2001. Even then, car sales took a hit and the auto industry needed a boost. Do you recall 0% financing? After 9/11 in late 2001, automakers, with support from the Fed's low rates, rolled out 0% APR deals massively to entice people to buy cars and keep the factories running. It worked to an extent. 2002 to 2005 were decent years for sales. That was a case where cheap credit saved the day for autos and the economy got away with a shallow recession. It underscores how important interest rates are. Drop them and you can revive demand. Hike them and you kill demand. Right now, we've hiked them, and demand is predictably being killed. So a logical response at some point, if inflation is under control, would be to lower rates to resuscitate sectors like housing and autos. The timing of that is crucial. Do it too late, you have unnecessary pain. Too early, and you risk inflation flaring up again. That's the needle the Fed is trying to thread as we speak. Another historical downfall: the oil shocks of the 1970s changed consumer behavior dramatically. People dumped big V8 sedans for small Japanese compacts in droves. It bankrupted some American icons like AMC, American Motors Corporation, by the late 80s. Today, we have a different kind of fuel shock, not a sudden price spike, but a long-term transition to electric. Automakers are pouring resources into EVs, encouraged by policy and, until recently, investor enthusiasm. But if consumers don't follow as quickly as hoped, we could see something analogous to the 70s, but in reverse. Instead of gas guzzlers piling up unsold, it could be electric cars piling up if the industry overshot consumer readiness. That's an ironic twist. The lesson from the 70s might be to be in touch with consumer needs and limits. In the 70s, Detroit lost touch, kept making tank-like cars when gas was $1 a gallon and people wanted economy. Now, one might argue some automakers lost touch by pushing too many high-end EVs when maybe consumers needed more affordable hybrids or efficient gas cars in the short term. Striking the right balance is key. History also shows that crises, as painful as they are, eventually lead to renewal. The 1980s pain forced U.S. automakers to become more efficient and quality-focused, or else die. The 2008 crisis led to a leaner industry with better cost structures and more innovative drive, and the rise of Tesla, etc., happened in its wake. The hope is that this current crunch will similarly force positive changes, maybe driving automakers to find ways to reduce vehicle costs, to truly commit to efficiency in production, to innovate in sales models, like more online direct sales, which could lower distribution costs. For dealers, the ones that survive will likely adapt, perhaps diversifying into new lines of business or adopting technology to reduce overhead or consolidating for economies of scale. If there's one more general lesson from all these episodes, it's that acting early can prevent a lot of pain. Early 80s, they didn't act until the pain was massive. Result, huge recession. 2008, authorities were a bit behind the curve at first, thinking subprime was contained, and then had to act massively when Lehman fell. In the pandemic, 2020, by contrast, the Fed and government acted extremely fast and big. Result, a very short recession, albeit followed by some inflation side effects. In our case, acting early might mean policymakers recognizing the squeeze on consumers and industries like autos, and perhaps adjusting policy like rate hikes a bit sooner to avoid choking things too much. It also might mean automakers adjusting production and pricing now, rather than waiting until they're sitting on a mountain of unsold cars. And for consumers, it could mean adjusting personal finances sooner, e.g. refinancing or paying down debt while you can, rather than waiting until you're in over your head. All right, enough about the past. I think we've established that while the circumstances change, the fundamental dynamics of boom and bust, of credit and demand, of fear and hope, those don't change. We've seen what can happen, and that knowledge is power if we use it. I often say that we should learn from history to make better decisions for the future. So, with that in mind, let's pivot to what we can do going forward. We've identified the crisis and its potential to widen. Now let's talk solutions, or at least coping strategies. What should investors be doing in this environment? What should an ordinary person or family do to get through this safely? And what broader changes might help us all in the long run? In the final section, I'll lay out some practical advice and insights on navigating the turbulent road ahead in true measured billionaire warning style, but with a hopeful twist that we can come out stronger on the other side. We've traveled through a pretty intense landscape of facts and warnings. If you've stayed with me this far, you might be feeling a bit anxious about what's to come. That's understandable. These are serious issues, but the point of analyzing a crisis isn't to stoke fear. It's to empower action. The road ahead doesn't have to end in disaster. We have choices as investors, as consumers, as a society that can determine how this all plays out. In this final section, I want to switch gears, pardon the car pun, and focus on solutions and advice. Think of this as a conversation about how to buckle up and drive through the storm. First, let me speak to a couple of specific groups that have a stake in this. For investors, if you're an investor, yes, whether in the stock market, bonds, or directly in businesses, now is the time for vigilance and prudence. Periods of economic stress separate the strong from the weak. Look critically at your portfolio. Which companies or sectors are heavily exposed to consumer credit and high interest rates? Are you invested in automakers, suppliers, or retailers that could see downturns? That doesn't mean you must sell everything in those categories, but you should understand the balance sheets and cash flow of those companies. In a high-rate environment, companies with heavy debt loads or those reliant on constant financing, like some fintech lenders, for example, could struggle. On the other hand, companies with strong balance sheets, lots of cash, and essential products can actually thrive by picking up market share, while weaker competitors falter. It's very much a Warren Buffett approach. Invest in quality businesses that can withstand tough times. Also, consider the benefits of diversification. If the U.S. consumer economy dips, maybe you want some exposure to other regions or sectors that might be counter-cyclical. Don't chase hype. We saw what happened with the EV hype. Reality sets in. Instead, look for real value. Historically, some of the best investment opportunities arise during crises, but you have to be solvent and calm enough to seize them. So ensure you're not over-leveraged. Maybe keep some cash ready to deploy if things get really cheap in a sell-off. And remember, markets are forward-looking. By the time a recession is in full swing, stocks may already have fallen, or conversely, by the time headlines declare the crisis over, the best buying moments might have passed. So try to stay ahead of the narrative, not behind it. In practical terms, focus on fundamentals, be cautious with debt, and be ready to act when others panic. That's how wealth is preserved and built in turbulent times. For everyday people, most of us aren't managing big investments. We're managing household budgets, careers, and trying to secure our family's future. If you're listening to all this and thinking, what do I do to protect myself? Here are some thoughts. First, be careful with debt. If you're considering a major purchase like a car or home right now, run the numbers conservatively. Interest rates are high. Can you really afford that monthly payment without stretching? It might be wise to postpone non-essential big purchases, or at least scale down. For instance, maybe buying a good certified pre-owned car for $20,000 is smarter than a brand new one for $40,000 in this climate. If you have existing debt, try to pay it down, especially any variable rate debt or high interest debt like credit cards. The less burdened you are by monthly payments, the more resilient you'll be if the economy hits a bump. Build up your emergency savings if at all possible. I know that's easier said than done, but even a small cushion can make a difference if you face a surprise like a job layoff or an unexpected expense. On the job front, it's a good time to invest in yourself. Build skills, improve your resume, strengthen your professional network. That way, if your industry is affected, say you work in auto manufacturing or retail sales, or any sector that might slow, you have a better chance of transitioning to something else or hanging on. Keep an eye on your credit score, because credit conditions tightening means lenders will be more discerning. A higher credit score will ensure you still have access to loans or credit lines if you truly need them. And psychologically, prepare for some uncertainty. If a recession hits, remember that recessions are temporary. Don't panic sell your 401k investments out of fear. Often the market recovers before the economy fully does. If you lose a job, know that you're not alone and there are systems, imperfect though they are, to help you get through it. Essentially, hope for the best, but prepare for the worst. If you're prepared, the worst often doesn't feel so bad. Now, some broader advice and thoughts. Stay informed, not overwhelmed. Knowledge is power. You've taken the time to listen to this whole analysis, so you're already ahead of a lot of folks who might be caught off guard. Keep paying attention to credible news on economic trends, but don't let doom scrolling consume you. There's a fine line between staying informed and becoming anxious. Economies have cycles, boom and bust, and we're likely heading into a more challenging phase, but it's not the end of the world. The United States economy, and indeed the global economy, has an incredible capacity for rebirth and innovation. The tech sector, for example, might provide new growth that offsets weakness in autos or housing. We might see infrastructure investments or growth in renewable energy industries, etc., that create jobs and support demand. So balance the bad news with awareness of the good and the opportunities. Policy matters. While you and I as individuals can't dictate government policy, we can advocate and vote for wise decisions. I'd like to see policymakers take this auto crisis and consumer debt issue seriously. For the Fed, that means carefully watching data and not being too rigid about keeping rates high if evidence mounts that the economy is really slowing fast and inflation is under control. A soft landing, where inflation comes down without a big recession, is still possible, but the window is narrow. For the government, it might mean targeted relief or stimulus if things get ugly. For example, in 2009, we got cash for clunkers, which helped clear old inventory and stimulated some car sales by giving consumers a rebate to trade in old cars. Something like that could be deployed again if needed, perhaps with a green energy twist. Rebates for trading in gas cars for EVs or hybrids, for instance. Policies to encourage lending to credit-worthy borrowers even during a downturn, maybe with some government guarantees, could prevent the credit crunch from worsening. And on a longer horizon, policies that address the root cause of affordability I'll see, like encouraging more competition in the auto market, or investing in technologies that make cars cheaper, or improving public transportation so people aren't forced to own multiple cars. All that could help structurally. As citizens, being aware and supportive of sensible measures and skeptical of ones that just bail out reckless behavior is important. Embrace innovation. Crises often accelerate change. I suspect this shakeup will push the auto industry to innovate even faster. Maybe we'll see new ownership models take off, like subscriptions or expanded ride sharing, because people shy away from traditional car buying. Maybe dealers will reinvent themselves, focusing more on service or community engagement or online sales to reduce overhead. If you're an entrepreneur or a problem solver, think about where the pain points are, we've covered many, and how you might solve them. Hard times can be the mother of invention. For example, one issue is people being stuck with long 7-year loans. Perhaps a startup could develop better ways for people to swap or trade out of car loans without ruining their credit, creating a secondary market for loans. Or perhaps more affordable EV models will be fast-tracked by startups or foreign manufacturers sensing an opening. As a tech guy, I always look at crises and say, what problem is screaming for a solution here? And there are plenty: high vehicle costs, inefficient dealership models, insufficient charging infrastructure for EV adoption, lack of good public transit in many cities which forces car dependency, etc. Solving any of these is both a public good and a business opportunity. Long-term perspective. For all the immediate drama, keep a long-term perspective. 10 years from now, the automotive landscape will likely be quite different. We'll have more electric vehicles, possibly some self-driving tech in mainstream use, maybe new forms of mobility altogether. The economy too will have moved on to new cycles. If you can, try to position yourself to benefit from the long-term trends that will continue regardless of short-term downturns. For instance, climate change mitigation is a huge multi-decade effort. Things like EVs, renewable energy, efficient infrastructure will grow in importance and investment. Aligning careers or investments in those directions could pay off big when the economy swings up again. Or consider the demographic trends. Millennials are in prime earning years now, and Gen Z is coming up, and they'll need houses, cars, etc. eventually, even if delayed a bit. There might be pent-up demand that, once conditions improve, will lead to a strong recovery in auto sales down the road. If you can survive until then, you might flourish in the rebound. community and solidarity. One more thing that's not financial advice but human advice. Tough times are easier when we face them together. If you know local businesses like a family-owned car dealership or your mechanic or a factory in town that are struggling, see if there's ways to support them, even if just by patronizing their services or giving them a kind word. If you have neighbors or friends losing jobs or stressed by bills, maybe we can help each other through sharing resources, tips, or just emotional support. I mention this because it's something I've learned through philanthropy and global health work. When crises hit, community matters a lot. It's not just about dollars and cents, it's about resilience, morale, and mutual aid. The American spirit at its best is about coming together when the chips are down. Finally, let me end on a note of cautious optimism. Yes, I've painted a rather dark picture of the current situation, but I remain optimistic about our ability to navigate through it. Why? Because we've done it before. Because for every sign of greed or folly that led us here, I see 10 signs of ingenuity and courage that can lead us out. The fact that we're even having this conversation openly and early means we're better prepared than in past crises that caught us by surprise. The very pressures we're experiencing now are forcing changes that will, I believe, make the economy more sustainable in the long run. For example, consumers pushing back on high prices will force businesses to become more efficient and value-focused, which is a healthier equilibrium. And remember, after 1982's deep recession, we got a long period of growth and innovation, the tech revolution, the 90s boom. After 2008 to 2009, we got a resilient recovery and a decade-long expansion, plus a lot of financial reforms to prevent a repeat. After the pandemic shock of 2020, we saw an incredibly rapid rebound. The point is, crises are painful, but they pass. The knowledge and adaptability we gain from them remain. I have confidence that 5 years from now, we'll look back at the unsold cars of 2024 to 2025 not as a symbol of doom, but as a catalyst that spurred positive change, perhaps more prudent lending, more sensible pricing, and a more balanced auto market serving consumers better. The road ahead may indeed be bumpy. We might hit some potholes, a recession, higher unemployment, some financial scares, but roads get repaired and cars, or perhaps electric trucks, keep driving on. As someone who's seen many upheavals in technology, business, and philanthropy, I can assure you, we as a society are remarkably resilient when we acknowledge problems and work on them. I often say, whether it was tackling polio or scaling Microsoft, that progress is possible when we combine clear-eyed realism with determined action. So let's be clear-eyed about this automotive and economic crisis, which I hope I've helped you to be. And let's also be determined to get through it with smart choices and solidarity. Thank you for listening to this in-depth discussion. Stay safe, stay informed, and as I like to say in uncertain times, optimism is often called unrealistic, but it's ultimately the optimism and effort of many that make better realities. We will strive for that better reality beyond the present challenges. Until then, take care of yourselves and each other.